The Federal Reserve is doing all it can to keep the economy on an even keel. Greg McBride, Senior Vice President and Chief Financial Analyst at Bankrate.com, joins us now. Hello, Greg. And the Fed lowered rates to zero in that emergency move, which shocked the stock market. But what does it mean for savers?
The Fed cutting interest rates to near zero levels means, unfortunately for savers, that the returns are going to plunge. CD yields are already dropping like a rock. Savings account rates will follow. And unfortunately for savers, this is going to be pretty familiar territory. The Fed had last cut rates to zero back during the financial crisis in 2008 and then left them there for 7 years. It's not to say it's going to last 7 years this time, but the bottom line is returns are going to be low and be low for a while. So it's really important to continue to shop around and make sure you've got your money in an online savings account rather than the big bank in town who's paying next to nothing.
Bring us up to date. What's happening with credit card rates?
Credit card rates are coming down. They are moving down as a result of the Fed having cut rates twice during the month of March. But it happens with a lag. It could take 2 to 3 statement cycles before you start to see that catch up. And even then, rates are still quite high on credit cards. The average credit card rate's still over 17%. So it's far from a bargain even once rates start to come down. However, look at those 0% and other low rate balance transfer offers. Grab those while you can. That's a great tailwind towards debt repayment. And if you have weaker credit, keep in mind that yes, rates may be coming down, but so too might your credit line as issuers start to take measures to mitigate risk in what's expected to be a recession.
What's your outlook on the economy? Bank of America is already out saying the recession is here. What do you think?
The recession is all but guaranteed at this point, and we were basically hitting the pause button on the economy due to the coronavirus outbreak. We will eventually hit the resume play button. What we don't know is how long is it going to last? How deep is that recession going to be? And what's going to be the overhang when we come out the other side of this? Yes, we will have a backdrop of very low interest rates that will jumpstart consumer and business borrowing and spending, which will need to give the economy some juice. But what's the unemployment rate going to be? How many millions of Americans are going to be out of work? I think those are the questions that we just don't know the answer to yet. And as a result, we may not see that immediate snapback in the economy that many had been expecting originally.
You're one of the highly esteemed professionals in this industry. How unusual or extreme is the situation that we are in right now?
What we're facing now is unprecedented. I mean, this isn't just confined to one region or even one country. It's the entire world. With the U.S. economy effectively hitting the pause button, this is uncharted territory. We are almost certainly going to have a recession. And the only question is, how deep is that recession? How long does it last? And what does it look like when we come out the other side? It is, however, temporary. We will get through this. And so it's important, particularly for investors, to maintain that long-term perspective.
Thank you so much, Greg. Our very best to you, and hope to have you back on the show soon.
Thanks, Angie.
For more Business First AM, check us out on social media. We're on Facebook, YouTube, and Twitter. And go to businessfirstam.com for where to see our show on TV.